Hey guys, this is the voice of Warily, and I'm making this cool video real quick to show some high probability scalps for beginner traders. I've gotten some questions about the scalping setups that I've posted in the Discord, and it's clear to me now that those require some slightly more advanced understanding of price action and order flow concepts to really grasp. That being the case, I want people new to this type of low time frame trading to have something easier to digest but still actionable. We'll talk about four setups that I use all the time, but these are going to be fairly basic versions of them, and we'll talk about later in this video how to add some extra edge to them, so be sure to stick around for that. Before we get started, follow me on Twitter. You can see the handle here on this screen, and also join the free Discord. Links to those things will be in the description, and also don't forget to like and subscribe. Flipping over to our table of contents, we'll kick things off with some general remarks, and from there we'll move into some of the relevant platforms that I use for these setups. Then we'll talk a bit about what scalping is, some pros and cons of it, and from there we'll go into the four setups that I want to discuss, which are going to be in order: the wick test, the maker's range, the swing failure pattern, and the lick scoop. The first three that we can see here are all fundamentally price action based. The last one requires some order flow understanding, but of course we'll talk about the necessary pieces of knowledge when we get to discussing that setup. Towards the end of this lecture, we will discuss how to increase EV with confluence, something that I realistically want to make a whole video about, but this to me is the key for being successful in this business. Then we will wrap up, of course, with some closing thoughts and a conclusion. So first, our general remarks. The best trades, naturally, as with all things in this business, are going to be in times and areas of high participation and or as a result of how the market reacts to impulsive moves. A lot of traders think that this principle only becomes relevant on high time frames, but seeing that price action is fractal, this is still very relevant on low time frames as well, and we still see high participation on a relative scale. Also, the setups in this video, as I mentioned, are stripped down to very basic frames and entry triggers so that people can easily understand and apply them. They therefore can and should be improved by finding other factors of confluence. Like I said, we will touch on that towards the end of this talk, so once again, be sure to stick around for that. What I use, of course, TradingView. If you're watching this video, you're familiar with this platform. It is, in my opinion, the premier web-based non-order flow charting service, and I use it for everything. It's just very smooth, easy to use, and allows you to get a grip of a lot of different markets in a lot of different ways in a very smooth and seamless manner. Atas, however the fuck you want to say it. Don't say ATAS though, that's too much. It is not really relevant in terms of executing on these setups. It's not crucial, but it is an order flow platform that I use. It is completely free for cryptocurrency, but you do have to pay for tried markets. That said, it's a great platform, and the reason why I haven't mentioned here, even though it's not necessary for executing, is because some of the screenshots for the examples of the setups use Atos, and I figured I would get some questions about that, so I'm mentioning it here to get ahead of that. Velo is a web-based cryptocurrency order flow platform, and the lick scoop is going to use Velo. MEXC is the crypto exchange that I recommend executing on as a beginner, simply because as we'll talk about in the pros and cons section of this lecture, as a low time frame trader, fees can really start to add up, and MEXC is relatively credible given the context of the space that we're operating in, and the fees are incredibly low. Give me one moment. Last but not least, Apex Funded is an online prop firm that allows you to pay for access to a simulated evaluation count, where if you meet the criteria and pass the evaluation, they give you somebody else's money to trade with. I've had a lot of good experience with Apex, and I highly recommend it, especially for people starting out. That way you're not throwing a bunch of your own capital at the markets while you're still trying to learn, but that you still have some skin in the table to sort of adjust you to that feeling. I would recommend before starting an evaluation, though, that you have some sort of basic understanding of how to analyze markets and execute on trades. Right now, they are offering a 90% discount if you use the link that I have in the description. I think I have a few links, but I get a kickback for here. I think I legally have to disclaim that. But Apex Funded is the one that I really want people to pay attention to here. It is a great online prop firm, and because volatility in crypto because the fees in crypto can really add up, I like executing on a lot of these, especially the first three. You can't really use the last one, the lick scoop, in traditional markets, but the first three you can absolutely execute on in trad markets, and I prefer to do it there just because it's cleaner to, it makes more sense from a fees perspective, and viewing levels is easier. Viewing levels and ticks is easier than it is in crypto, which was something I can make another video discussing. But for now, yeah, Apex, these first three setups are great for executing on in trad markets, and right now Apex is offering 90% off on evaluation accounts, which for a 50K account comes out to $16 for an evaluation account. Now, what is scalping exactly? So scalping is profiting from minor price changes in the price of an asset. So in traditional understandings of day trading, you're really looking for, some sort of price lag to capture, and in scalping, we're really just looking for, a few percent, a few ticks, and getting in and out of the market very quickly. That lends itself to a relatively high frequency of trades in a given session. So where if you're a day trader or an intraday swing trader, you're taking, this is arbitrary, but anywhere from, 1, 2, 3, 4, sometimes 5 trades a day. As a scalper, though, we're looking for 10, 20, 30, 40 trades a day just because of the in and out nature. We're always in a position to capitalize on the next opportunity. The reason why I prefer this style of trading, well, one of the reasons I prefer this style of trading is because for me, it's just easier to catch and manage small moves as opposed to large swings in price, and scalping allows me to execute in that way and with that expectation. Lastly, because we're not looking for large swings in price, we are compounding our wins in the form of a large number of small profits, which of course isn't something you should necessarily be focused on if you're a beginner. You should just be focused on developing your edge and wanting to win, and that will come later, but this is an important thing to mention. Over to our pros and cons. We'll start with the pros. So the pros of scalping is that we have a minimal amount of time that we're exposed to the market. It's not uncommon that my entries are seconds before I'm either stopped out or in profit or taking profit, and that kind of hedges out any opportunity for extended moves that could lend itself to different news events that you don't see coming, or having to manage a position over a long period of time and think about that when you're away from the computer trying to touch grass, essentially. Another pro of scalping is that because of the low amount of time that you have to actually execute, and the low amount of time that you're actually holding the trade, not a lot of research is needed into executing on a scalp setup. Because if you're a swing trader where you're looking at a setup for a few days before you're executing on it, that's a lot of time for your counterparty and yourself to sort of maximize the amount of research that you're willing to put into a setup and really fully fledge out a swing trade thesis. With scalping, though, a lot of the time you have seconds, maybe a minute to actually execute on a setup. Another thing that I like about scalping that I think is often overlooked is that you can really feel the effects of how time can play a role in the thesis of a trade. With these setups, we're really looking for instant reactions. And a lot of the time, if you don't get that, that's a signal that whatever you thought was going to happen probably isn't going to happen. And you can cut the trade based on a time invalidation before you get stopped out from a price action perspective and save yourself some money. The cons of scalping, as we talked about earlier, probably the biggest thing in my opinion is the high fees. So especially in crypto, but in trad markets as well, if you're taking 20, 30, 40 trades a day, you have to factor that into the profits or, even losses. There have been times where, I have a down day and for some reason I'm just not thinking about fees, and then I go to check to see what my drawdown actually is, and I realize that, for example, instead of being down $1, I'm down $1.50, or if I'm down $1,000 from drawdown in the trade, I'm actually down $1,500 from fees because I'm taking such a high frequency of trade, because I'm trading so frequently and I have such a high number of trades taken. So definitely that's something that you're going to want to pay attention to in this style of trading. These next 3 points kind of all play together. Really, scalping requires a lot of attentiveness, a lot of focus, and you're staring at charts for long periods of time, and you need to be able to have a constant grip on what's happening in the market so that you can react quick and execute on your setups properly. The last thing is that because we're constantly pressing buttons, a lot of the time that lends itself to a sort of itchy trigger finger or more emotional connection with our trades, which is ironic because you would think that because we're taking so many trades that we sort of get numb to the process of entering in and exiting. But, if you're taking 2, 3, 4, 5 trades in a row that are all shit, you might start getting an itchy trigger finger thinking to yourself that you need a win because you're experiencing some drawdown. And even if you're winning, you can get into a frame of mind where you're just completely over managing trades, which can still happen in small rotations. So overtrading is definitely something that you want to avoid as a scalper, but it is something that happens to a lot of traders that employ this style. Great, so now we are on to our first setup. And we're going to start things off with the wick test. For all these setups, like I've mentioned, they are relatively stripped down variations of what I actually trade. That said, these are still very much employable as is and are great setups which are easy to build on top of if you can find your own factors of confluence, which once again we will touch on towards the end of this lecture. Each of these setups, we are going to have a step-by-step process to actually enter the trade, and then we will also have a section that shows you how to frame the trade in terms of what you're targeting once you're actually entered. So in other words, where we're taking profit and our invalidation. There's no setup that's going to be right 100% of the time. Eventually, you're going to have a trade that doesn't work, and it's important to understand where that trade isn't working so that you can cut it and avoid more drawdown. Each setup that we're going to talk about will have both of these things, how to identify our targets and what our invalidation is. So starting off with the wick test, we are going to first look for a relatively small candle, which we will refer to as a churn candle. Following that, we want to see an impulsive candle in the opposite direction. So if our churn candle is down, we want to see an impulsive candle up, and if our churn candle is up, we want to see an impulsive move down. After that, we're going to look for a retrace to the churn candle. On the candle immediately following our impulse candle, we're going to look for a retrace to our churn candle. So if our impulse candle is up, we're looking for a move down back to our churn candle. If our impulse move is down, we're looking for a move up back to our churn candle. And you can see the setups, the two different setups, the long entry and the short entry down here. So in this example on the left, our bullish wick test, which would be a long entry, we see our churn candle down, our impulse up, and then a retrace back to the top of our churn candle on the very next candle. And then from there, we're going to look for a move up. In this case, our target is a halfway retrace of the impulse candle, or a halfway retrace of the impulse retrace candle. So this is our impulse retrace candle. We're looking for us to pop back up around halfway up the size of the candle. So for example, if this retrace leg here is a full point, we're looking to take 2 ticks out of this move. And on the flip side of that, our bearish wick test, which is our short entry. We have our turn candle here, our impulse down, our retrace back up, and we are looking for a pop back down off the test of this wick to take a profit. And validation is just a closure or a wick below the turn candle. Really, I have closure mentioned here, but you can take a wick as well. That's kind of something that you just have to determine for yourself. Examples of the wick test. So we're going to pop over here. So how I'm going to do this is I'm just going to go bar by bar, and if I see a wick test, then we're going to talk about how to take that. So starting here is really our first turn candle, followed by our impulse. Now we know that this is a valid setup, assuming we get the retrace to, excuse me. I don't know how to mute my fucking microphone because I'm a retard. There we go. I'm alive. So let's start that over and try that again. This is our first impulse candle here that follows a churn candle. So because our impulse is up, we're looking for a retrace back down to the wick high of our turn candle, which we get in this case, you can see right here. And really we're only just looking for a pop back up into this area to take profits, which we get. Just to reiterate, as a scalper, we're not looking to capture huge moves like this. This is a swing trader's job. Our job as a scalper is to capture this, just little moves, and let those add up over time, over a high frequency of trades. Moving on, I wouldn't call this a churn candle, which we'll talk about in the nuance section, just because even though the candle body itself is so tiny, the wick is absolutely fucking massive. So I would not count this as a churn bar, and we'll talk about that a little bit more on the next slide. Really, our next setup is here. We get a churn bar, followed by an impulse, and we're looking for a retrace to the wick high of the churn bar, which we get. And you see the move here kind of gives a bit of pop, which sometimes you can capture, especially if you have under other aspects of confluence in taking this trade that sort of lend itself to an understanding that, you know, you can play this for a larger move. But this, as a scalper, should by no means be your expectation, especially if you're just taking these bare bones setups. But regardless, this does work, even if you're just stealing a few ticks. Moving on, our next setup does not come in here, which we'll also talk about in the nuance section. You can see that even though if this candle closed up here, it would be relatively impulsive, the wick on this candle is too large, and in this case, we actually even close below the wick, so I would absolutely not take that as a wick test. It's fundamentally impossible as well, considering that we want to retrace to the wick high, but here we're already below the wick high. Here's another good churn candle, followed by an impulse, but in this case, you don't have a retrace to the wick high, so, you know, unless you're being very aggressive, which, I mean, you could theoretically take it off of this swing high. If you're a bit more aggressive, that's not personally something that I would recommend as a beginner, but it is something that you could consider. It does work in this case, but that's something you'll have to explore for yourself. This is a setup I would consider taking. The impulse isn't quite as big as I would like it, but it's not horrible. And you can see it works quite well. We have another churn candle. Really, if you're taking this, you also have to take this. And based on a closure, it doesn't really look like it works. But it might have worked intra-candle. But, you know, if you're taking this, you kind of also have to take this. Although you are feel free to use your own discretion and come to your own factors of confluence to increase the probability that something like this works out and to really nail down when to enter these things. But if you're just eye testing this from a price action perspective, these are essentially the same setup, and you kind of have to take both. This is an S churn bar followed by an S impulse. In this example, though, you don't get a retrace to the wick high, so you have to skip this. Unless, again, you want to take the range high, which I wouldn't recommend if you're just trying to play this as the basic entry that I'm teaching here. Next opportunity is this churn candle followed by this impulse. Like I said, you really want to see it retest the wick on the next candle, maybe the following candle. So really you have a 2-candle window, but something like this where you get a very rounded retest isn't something that I would take for the wick test, and we'll talk about in the next setup where something like this is okay, but for the wick test I wouldn't really recommend this. Our next setup, you might look at this and think that this is a valid setup, and if this candle was an up candle, I would say that's a reasonable assessment, but remember we want our churn bar to be in the opposite direction of our impulse. Give me one moment. All right, the final example that I see on this chart is this churn bar right here, followed by a retest of this wick. In this case, it's not the immediately following candle, but it is the next one, so you could take this as a valid wick test. I really wouldn't go more than 2 bars though. All right, that's it for our examples. Excuse me one moment. All right. Moving on, talking about some nuances. So the wick test can be taken as a reversion or a continuation scalp. So a reversion scalp, or a reversion setup would be, fuck. I'm gonna have to blur that, that's annoying. Yeah, so a reversion, the wick test as a reversion trade would look something along the lines of down leg, consolidation, and then you get your wick test that allows you to pop back up. As a continuation trade, you're stair-stepping your way up, and this is direction neutral. It doesn't really matter what the continuation or reversion directions are. I'm just using a bearish example, or well, a bearish leg into a bullish wick test for the reversion and bullish continuation for our continuation version. But essentially what you're looking for is a move that's trending up, and you want to retrace to sort of put in an opportunity where you're creating a churn candle followed by an impulse followed by a retrace, and then you can take it higher for the continuation of the leg. Another thing that I kind of alluded to briefly in our examples is the impulse candle close relative to the churn candle wick. So really, if you're getting a churn candle where it has a massive wick in the direction of the impulse, it kind of doesn't allow the impulse to shine. You really don't want to take something like this. Realistically, you want the wick to be pretty small relative to the impulse and somewhere around the same size as the churn candle. Retest speed, like we talked about in the examples, really you want to see the retest happen on either the immediately following candle or the candle after that. Resting limit, so I want to talk about the types of orders that you're going to use for each of these trades as well. With the wick test, because you are waiting for a retrace and you already know that you want to enter before you get to that level, you can just leave a limit order right at the top of the wick or the bottom of the wick in a bearish example. And I recommend using bracket orders for this as well. Moving on to the next setup. This is the maker's range. Once again, entry trigger and frame for each of these setups. We'll start with the entry trigger for the maker's range. Essentially, we're looking for a tight consolidation, which you can see here. From there, we're looking for an aggressive move or an impulse out of the consolidation. Following that, we want a retest of the previous range that we impulsed out of. Our invalidation is a closure further than the opposite end of the previous range. So here in our short entry, for example, we have this range, we have a bearish impulse out, and on our retest, if we start trading above the previous range high, that would be considered invalidation. As a target on our retest, we're really just looking at this overall new consolidation for the average candle size, and we're just taking the average candle size as the target for after we enter on the retest. Here is an example of long entry, tight consolidation, impulse out, retest, trade a high. Some examples of the maker's range. Essentially, we're just looking to map out our ranges here on the basis, and essentially we're just operating on the idea that all consolidations are more or less going to provide some sort of reaction. And I could get into the nuances of why that is, but you can see it works quite well. Here in this example, of course, you have these deviations here, but when you get a proper impulse out, and you can see we retest it, it puts in a pretty quick reaction back down. And we're not necessarily looking to capture this entire leg here. Like I said, we're really just looking for average candle size to trade down out of that. But now that we have our new range, we can set this up, and when we impulse out of here on a retest, you can trade it back down. One moment. Excuse me. Nuances of the maker's range. Once again, these can be taken as reversion and continuation. So if you need a refresher on that, you can go back to the wick test nuances. Again, the impulse move relative to the previous consolidation is something that you kind of have to learn, get a feel for. Anything too tight can really just be viewed as an extension or an expansion of the current range. Anything too large almost makes the range not irrelevant, but it makes it less likely that orders are going to want to hold that up. Just because if you think about sort of a battering ram at castle gates, you're not going to break through the gate if you're just kind of forcing the battering ram up against it, and you're really only coming back like a foot or two, and you're just kind of pressing on the gate with the ram. But if you bring price very far, if you bring the battering ram very far from the gate or the level, and then you slam it in, chances are you're going to have a lot more of an effective result. Chances are that's going to be a much more effective action. So you do kind of have to find the sweet spot in terms of the move away from the consolidation. Retest speed. With these sorts of things, you don't want to necessarily get an immediate retest, although it is fine. You are going to have a lot more success, though, if you're getting a little bit more of a rounded retest. Drift retests. These things work best if you're not impulsing right back into the level, but if you're instead grinding back to it. First test, best test. If you're trying to take a second test of a previous consolidation, it's not going to work as well as the first one. That's where most of the participants are still going to be interested in getting orders filled. So really, we're only looking for a first test. Resting limit, like with the wick test, you know the entry level you want to enter on, you can just leave a resting limit there and get filled when price comes back. Moving on to the SFP, I think people who are familiar with swing trading might be surprised to see this here, just because this is typically a pattern that, or an entry trigger that you would only expect to see for swing traders. That is the primary context that it's traded in and understood in. But I think that it's a quite good scalping pattern, especially for trad markets. I find that it works especially well there. But essentially, if you're not familiar with the swing failure pattern, or the SFP as you'll hear me refer to it and write it as, we're looking for identifying swing points. So we'll look at our short entry trigger here while we look through the entry triggers just to follow along. We're identifying a swing point. You can see it here in this yellow circle. If you don't know what a swing is, I suggest checking out the beginners resources in the Discord, and there's some links to some good videos on that. But here we have a swing high that we want to map out, and then after that we're looking for a push through the level, which you can see on this wick, and then a close inside of this level, which you can see this body here. From there, in the case of this short entry, we're looking to trade down, and in the case of a long entry here, where we have this swing low, we trade through it, close inside, we're looking for a trade up. Like with the maker's range, we're looking for our target to be around the same size as our SFP candle. And our invalidation is a closure or a break outside of the SFP. So in our bullish or our short entry, we're looking for a break above the wick that pushes through our swing. And in the long entry example, we're looking for anything that goes outside of the wick low of our SFP candle. Once again, whether you invalidate on a closure or a break is really up to you. Now, I'm not going to go through all of the SFPs in this range just because I do believe there's quite a lot of them if I remember correctly, but we will go over a few. I find that in trad markets this works especially well, and especially in tight consolidations. If you think this is after markets, or if you think that this is after hours because of the times here, I'm EU based, so these time frames are in UTC. So once again, getting started, we're just looking for swing points to map out. And I'm kind of just going to do a quick eye scan, so I'm probably going to miss a few here, but I'm going to look for 2 or 3 to show you guys. So this is our first one. We have a swing high right here that gets traded through and closed below. This one actually, hold on. Let's start from here. So here we have these sort of this quadruple test that gets traded through on this candle, and then it trades below. So this would be one example that works. Next one, we have this previous swing gets traded through, close below. We would expect to move lower, but here we actually get stopped out. We'll look for a couple more here. Here's one that works pretty well. You have a swing here. You trade above it, close below. So now we're expecting a move lower, which we get. Here's another one, swing point. Actually, there's a few here. These all kind of line up. You trade through all of them, close below. We're looking for a move lower, which we get. There's another one here, swing point, swing breaks, close below. We're looking for a move down. In here, there's also a bullish example. We have this swing low. We break through it, close higher, looking for a move up. I think I covered, no I did not. Okay. Here's another bullish example, and this is the last one we'll do. We have a little swing low here. We break through it, close inside, we're looking for a move up. And by now you should understand the SFP. If not, we have the Discord. Feel free to come in and ask questions. But those are some examples of the SFP, or which is short for swing failure pattern. Some nuances of the swing failure pattern, and this is something I want to actually go back to the examples chart for. The first one we'll talk about is the squid hands. So the squid hands is like in this situation over here. And let me see if there's anything a little bit better that we can look at. This is fine. Actually, we'll pretend that this is something, so let's just extend this candle. Actually, let's extend this candle here. So let's pretend that this, oops. So let's pretend that this down candle here actually has a wick off of it coming like that. I'm not interested in taking this because I want to see a clear swing be put in place. If I see a bunch of candles that are all equal high, back to back to back, like we get here, we get these kind of this triple test here, and then we get a candle that on the wick breaks through that and closes below it. I'm not interested in taking this just because I want to see a clear swing point. If we get something like this, okay, this is a clear swing, lower high, high, lower high, lower high, lower high, higher high, lower high. And then we break that higher high, close inside of it, take that down. That's what I want to see. If I see a bunch of candles that are rejecting off the same level, in this case, It is to the pip because this is ES and you can clearly see the ticks here. I'm not interested in taking that. I want to see, like I said, clear swing point. So that's what I call squid hands, and I do not take those for this type of setup. Wick length. So over here, you actually get an SFP entry. So you have this swing point here, even this swing point here, that gets traded through on this and closes below. So from there, you would expect us to trade lower. And depending on how this candle prints, this could have worked. But you can see that if it traded up before it traded down, you're taking a pretty nasty stop out. And as long as you're managing your risk and you understand how to size, this can feel the same as something very small. But the distance here tells me that we're kind of getting a volatility spike, and this could do some fuck shit, which it absolutely does. So because this wick is so large compared to the rest of the candle, this is something that you could use your discretion and say, okay, this is uncomfortable for me given the risk management parameters. I don't feel comfortable taking this, and that would absolutely be a reasonable thought process. With these SFPs, a lot of the time they work pretty quickly and you don't get a retest of your entry, so you do have to mark it in on these a lot of the time. On to our final setup here. We're going to be talking about my personal favorite out of all of these, which is the lick scoop. This one requires a little bit more of a nuanced understanding because we're going to go over some order flow principles, and they will require the use of order flow indicators. So briefly, there's some acronyms here that I want to address. OI stands for open interest. Open interest is just a data point that reflects all of the open positions in the market for a given asset. FUTS is just short for futures. CVD is cumulative volume delta, which is a measure of market buys and market sells in the market for a given asset. And FUTS CVD just means future CVD as opposed to spot CVD, which isn't going to be particularly relevant for discussing this setup. Excuse me one moment. Alright, so for actually entering on the lick scoop, we have, as opposed to just a general entry sequence like we have with the other setups, I've split these up into a long example and a short example. So in the long example, to enter on the lick scoop, we are looking for an OI flush or OI down. Then we are looking for future CVDs to spike up in conjunction with long liquidations and a lot of sell volume. Once again, that is our entry trigger to go long. OI down with FUTS CVD spiking up in conjunction with short liquidations and big buy volume is going to be our trigger to short. Framing the trade, we are looking for a violent, quick capitulation candle down, and then as soon as that starts, or down or up, and then as soon as that starts reverting and picking up and leaving a wick behind, that's when we're really looking to enter, assuming we've seen the liquidations come through. And this is a reversion trade, so if our capitulation is down, we're looking to market long, like I said here. And if our capitulation is up, we're looking to market short. We're looking to short the market. Targets with these, a conservative target would be just anywhere in the fair value gap of the impulse. The more aggressive target would be to retrace the entire capitulation impulse, and the very aggressive target would be next liquidity. The invalidation for this is a closure or a wick below or above, depending on what we're taking the extreme of the impulse. Some examples of the liquidation scoop, which is what the lick scoop is short for. We have one really good one here, and then one that I would not necessarily be interested in just based on what I'm seeing here. So first off, obviously the histogram here at the bottom in the blue and red is our volume. Blue is buys, red is of course sells. For aggregated liquidations, you can see that the blue bars that tick to the top, those are a reflection of shorts being liquidated, so it's a little bit counterintuitive. And then The red bars going down are a reflection of longs being liquidated. Open interest, whenever you see a blue open interest bar, that is open interest increasing. And if you see a red open interest bar, that is a reflection of open interest decreasing. So for this example, we're really only paying attention to the red bars. The last thing that I want to pay attention to here is the future CVD, which is just the black line, this black oscillator in the bottom panel. We are looking for that to spike either up or down depending on what direction liquidations and buys are coming in. So in this first example, the way I identify this quickly without having to pay attention to all of these things is you can see that for the most part, the liquidations are pretty flat, and then every once in a while you get a spike. Whenever we see these spike in liquidations is when I'm looking at CVDs and open interest and volume. So in this first spike where you see a bunch of shorts getting liquidated, this is technically a setup just because you see CVDs trade up in conjunction with OI flushing and a pop in short liquidations and a relatively large amount of buy volume. The reason I wouldn't take this is because, like we can obviously see here in the next setup we'll talk about, this data here isn't really jumping off the page in me. When I see a good lick scoop setup, that's usually as a result of the data absolutely jumping at me. So here you see a clear spike down, this massive OI flush, massive liquidation candle, huge buy candle, huge sell candle, and here you just don't really see that. So while this is technically a setup that you could take and it does work well, it's not necessarily something that just looking at this I would be interested in. Onto the long example, you can see we have a bunch of sells coming in, a bunch of longs getting blown out, a huge flush in open interest, and a big spike down in CVDs. That's our cue to get long and trade this up for a few percent. Some nuances of the lick scoop. You have to be very fast with this, as a lot of the time you are competing against people with better means for execution, faster means for execution than you. So a lot of the time you're marketing in or limit chasing these entries. Once you get good with this sort of thing, you can understand when these are actually going to stop working and will stop playing the reversion move and reverse lower. So that is something that you can pay attention to. And the order flow significance, like I said, you really want to see the data jumping off the page at you for taking this type of setup. Nice voice crack there. Lastly, and this is something I want to make an entire video about, but I do want to touch on it here just because all these setups that we talked about are relatively bare bones compared to how I actually trade them. Once again, they are completely actionable in this state, but really what you want to be doing is while you're trading them, you want to understand how these work on a more granular level. The thing that I trade is order flow, and that's the primary tool that's the primary category of tool that I leverage for increasing confluence with these setups. So I look at things like trapped traders, tape speed, oscillator divergences, trend identification, and the significance of price action after leaving the reference level and the significance of the reference level itself. Those are all examples of things that I look at and that you can look at too. But realistically, there's edge everywhere, and anything that you can think of is worth exploring. Almost anything that you can think of, realistically, probably anything that you can think of offers some sort of way to increase your confluence and your edge in regard to not just these setups, but just trading in general. There is edge quite literally everywhere. So some closing thoughts. Scalping is a great approach given its allowance for an in and out relationship with the market. You don't have to think about you being in a position while you're doing something else. It allows you to really just be in the moment and not really have to stress about having an open position if you're off somewhere trying to take your mind off of the markets so that you can have a healthier relationship with the markets when you're actually playing them. Scalping, as a scalper, we're not really looking to capitalize on large moves in the markets over a few trades in a day or a week. Really, we're looking to take a high amount of trades at very quick intervals in a session to produce our results with a accumulation of smaller wins. And cutting when we're experiencing invalidated trades before they get too out of hand. Once again, all the setups that we talked about in this video can be employed as they are, but establishing additional points of confluence can lead to higher expected value from them. Thank you guys for watching. You can follow me on Twitter at WearyTrader. You can see the handle here. If you want to pay for my condoms, I go through a lot as a gay man. And the address for my Ethereum wallet that you can donate to is right here. Other than that, we have a free Discord where I'm constantly in there answering questions, giving advice, and I'm a ping away. There's a bunch of great resources in there as well, and I'm posting swing setups, scalp setups that I'm looking at or have taken, or things that you can take yourself constantly, and always adding more resources in there. Please pray for my condoms. Don't forget to like and subscribe, and I will see you in the books.